welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to take a hard look at the travails of the debt mutual funds following the recent upheavals that we've seen in the debt market. Thanks in part to the runway success of the mutual fund Sahi Hai campaign, assets under management or AUM of the mutual fund industry has grown by leaps and bounds, with retail investors increasingly preferring mutual funds, especially debt mutual funds, to bank deposits. But are debt MFs all that they made out to be? Or has their appeal worn off now? The Z episode has brought mutual funds exposure to loans against shares under the spotlight. To earn higher returns for their unit holders, many debt mutual funds over the past couple of years have entered into questionable deals that cast a shadow of the future of debt mutual funds. And that's what we're going to discuss in this edition of Macros with Mythili with our panel of experts. N.S. Venkatesh, CEO, AMFI, Association of Mutual Funds of India; Anant Narayan, Professor, SPJ Institute of Management Research, Bombay; and Mr. J.N. Gupta, former Executive Director, SEBI. Welcome to the show, Venkatesh, Anant, Mr. Gupta. There's little doubt that thanks in part to the success of the mutual fund Sahi Hai campaign and the bull run of the past few years, mutual funds have caught the fancy of the public at large. But given what we are seeing in debt markets today, will debt MFs remain the go-to product for investors seeking an attractive, simple, liquid and most importantly transparent vehicle? Let me start with you, Venkatesh.
I would say that the future of debt mutual fund is intact in the sense that we will see more growth happening in the debt mutual funds. This is mainly due to the fact that the financial savings will move towards the mutual fund, because there you have the advantage of more transparency and more liquidity, and at the same time a reasonable amount of return which on a tax adjusted basis looks to be better off than the normal other debt avenues which are available to the investors. So I'm quite hopeful that the debt mutual funds will grow at a pace which is reasonable in the next couple of years.
Would you agree with that assessment, Anant? And how important is it really to distinguish between institutional and retail investors in the context of debt mutual funds? And do you see the recent volatility in debt funds, posing a problem for retail investors, many of whom tend to see debt mutual funds as fixed income instruments, which they clearly are no longer so? Anant?
Mythili, look, I think we have to start with the broad objective that we do want our debt capital markets to expand and become a lot more deeper and broader. We don't want all the lending and channeling of savings into investment going only through banks. I think everybody agrees with this, including all our panelists, including RBI, including SEBI. Now, during the course of this, we've seen a yeoman service being provided by mutual funds in enhancing the liquidity of and the popularity of debt paper capital markets. And to that extent, that is to be lauded. Of course, the growth has arguably been rapid, perhaps too rapid in the last few years. Particularly in the equity funds, to be honest, but also in the debt mutual funds. Now, the basic problem that we have as of now is that the overall assets under management for debt mutual funds is extremely large in comparison to the actual secondary market liquidity. And that causes all sorts of vulnerabilities which show up every time you have a market event. I think the broad thesis and the broad focus has to be on addressing the secondary market liquidity rather than saying that debt market mutual funds are good or bad. We do need capital markets to develop. Debt mutual funds are an intrinsic part of that effort. The effort has to be in strengthening the secondary market volumes rather than focusing elsewhere.
You're right on that, Anant, but the problem maybe with mutual funds, debt mutual funds, is that they've grown too fast for their own good, which brings me to my next question to you, Mr. Gupta, is that the future of debt mutual funds really can't be divorced from the growth of the debt market in the economy, especially the corporate bond market. Both SEBI and RBI have been trying very hard to push the development of the bond market, but this cannot really be divorced from the problems of the larger ecosystem, which is marked by poor liquidity, lack of proper valuation norms, poor disclosure, delays in recovery in case of default and so on. Given all this, would it be correct to say that the retail Indian investor is not really yet ready for debt mutual funds? Mr. Gupta?
I think you have hit the nail on the head. If you had seen yesterday's piece in Economic Times on the debt mutual fund, you would see what is the constitution of people who have been putting money into the debt mutual fund, and you will find that in a debt mutual fund around 60% money had come from corporates, and in liquid fund more than 80% money had come from corporate. That itself is a very strong signal that something is not right as far as the mutual fund in the debt space is concerned, because the diversity is not there. That is one. The second point, as you rightly said, that valuation issue of credit rating, and some sort of a panic reaction. What have you seen? If you have seen beginning from the IL&FS crisis, the panic reaction set in and everybody is running here there because there's some problem, and the recent problem with G and Anil Ambani group companies. What I would say that on one hand you want to develop bond market and deepen the bond market, but mere regulatory diktat cannot develop liquidity in bond market or something. The other issue that is there, that if you look at, Professor was saying that disintermediation is happening and other sources of finance are coming, not only the banks are concerned. But then you look at what are the regulations for the bank and what are the regulations for an institution like debt mutual fund or even NBFC, and you find lot of gaps. So somewhere I am saying that we are still evolving and we have a long way to go when such funds and such instruments will stabilize. It will need couple of things. One, as you rightly said, a bond market or a fixed instrument market where the liquidity is there. The second, the incoming money has to be very, very diversified. And I would add one more problem. The debt mutual fund, some sort of there is a governance issue in the companies related to the debt mutual fund. What is happening? The companies are using the mutual fund as an instrument to ensure that they vote according to their requirement. So some sort of a hidden give and take is there, that I invest in your fund, so you vote, you will not vote against me in AGMs. So this issue also will have to be taken care.
Venkatesh, are debt mutual funds inherently more adversely impacted when meltdowns like the IL&FS incident happen? Because unlike banks, insurance companies, pension funds, they lack the holding power needed to tackle the redemption pressure. At the same time, they are required to disclose their NAVs on a daily basis. So is there a case for some kind of special liquidity window for mutual funds, at least for the holding of high quality corporate bonds, like a repo window for banks, that is in times of trouble? RBI had done something like this in 2008 crisis. Or does that go against a very underlying ethos of mutual fund investments, that they are subject to market risk? Venkatesh?
I would say that anecdotally, if you look at the 2008 crisis and the 2013 mini crisis which we had, this liquidity facility was more or less given to the mutual funds, but it was not utilized to that extent because the mutual funds were able to manage their liquidity risk very well. It is not as if the mutual funds do not have liquid assets in their portfolio. If you look at even today, if you look at it, the mutual funds have fairly liquid assets in their portfolio, whether it is the earlier the collateralized borrowing and lending obligation, the CBLO, now which has changed to the TREDS. So I think they have enough liquid assets like the treasury bills and all those things in their portfolio. But I tend to agree with Anant when he is trying to say that you need secondary market liquidity. So to that much extent, maybe can we look at the repo facilities? So whether globally the central banks do accept the corporate debt paper for the repo facilities. So why not in India? If it requires an amendment in the RBI Act, RBI could consider amending that RBI Act so that at least to start with a AAA paper could be utilized for the repo facility, which will add more to the secondary market liquidity. So I think that is one thing which we can look at this particular point of time.
Okay, except that what is AAA in India one day, suddenly it becomes almost D the next day, which is really where the problem really lies. In fact, Anand, the received wisdom is that it's only banks that are really systemically important. But take the case of a recent large mutual fund that had exposure to IL&FS paper and was forced to sell its holding of some other bonds at a discount, a huge discount, setting off a panic about the entire NBFC sector, a disquiet that really continues to this day, apart from adding to redemption pressures on other debt funds. So how can we mitigate systemic risk for mutual funds? Or is it that the regulator should not be concerned about mutual funds given that they are capital market investments?
I would suggest 3 ways going forward. One, given that secondary market liquidity is low, if you have large redemptions because of a stress event, the market simply cannot handle redemptions, even for good quality paper. So whether we like it or not, like Mr. Venkatesh said, you do require a contingency plan. Given there is no lender of last resort for corporate bonds, you do need a contingency plan like we had in 2008 and 2013, where repo windows can be opened maybe through banks for redemptions to come through. If you have such a window, probably you won't even have a panic in the first place. Second part, we have to address the secondary market liquidity. There are lots of committees that have been built over time, which have given a lot of recommendations, including the one that Mr. Venkatesh mentioned about RBI starting, amending the RBI Act to allow, corporate bonds to come as part of their liquidity adjustment facility. So that the entire gamut of improving secondary market liquidity is the second part. Third is the point that that Mr. Gupta was making, that there are issues in the overall ecosystem which need to be addressed. Credit rating agencies, this whole question of loans against or lending against shares, is it really debt or is it equity like risk which is masquerading as debt? That entire egregious section, which I still think is a small portion of the entire AUM, needs to be addressed, and that will evolve over time. No system is born perfect. We'll have to address those issues as they come along. We can't concentrate only on that and paint the entire ecosystem as being bad because of those egregious examples.
I hope you're right on that, Anand. But Mr. Gupta, in our anxiety to promote mutual funds, including debt mutual funds, are we really guilty of papering over the risks? And is there a danger that the huge amount of money coming in by way of SIPs could in fact aggravate the risk, as we have too much money chasing too few good quality assets? Could that be a possibility, Mr. Gupta?
I would say that we should not panic at this stage, because as Venkatesh said, that it is an evolving product and our market is still evolving. What we need to do is to plug the loopholes and see what is done. The issue is very clearly that when the repo facility or some sort of a contingency facility is built, who takes the loss? The issue is, if you are in a situation where the underlying asset is going to be valueless tomorrow, as happened in many cases, then if you take a repo facility, so only what you are doing is you are postponing the problem for few days or few months, because ultimately that asset is worthless. In that case, I would not suggest a facility, because you are giving exit to investor today, and some other investor will come into that portfolio and he will lose. So some sort of you are postponing the problem.
Absolutely. I think we need to be clear that how should mutual funds be regulated, particularly debt mutual funds, which really almost mimic banks. But I'm afraid it's time for us to slip into a very short break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with three market experts on the future of debt mutual funds, given what we're seeing happen in the debt market. Venkatesh, everybody spoke about lack of liquidity, and the fact is that lack of liquidity for lower rated bonds means that when faced with a sudden credit downgrade, mutual funds often are compelled to sell the better rated paper to meet the redemption pressures. As a result, patient investors who stay with the fund get penalized. Hence the recourse to what is known as side pockets. But does this alternative of carving out a side pocket materially improve matters, or is it merely optics? You're just pushing the can down the road. Venkatesh?
This has been debated even in the Mutual Fund Advisory Committee, and we believe as an industry that side pocketing is one of the best tools to happen, for the simple reason it carves out the stressed asset to a separate pocket, and then you work on the recovery of that. So that we believe that that's a temporary phenomena, and we are quite sure that there could be an upside to that particular thing, so that the upside is shared with the initial investor rather than the new investor coming in. So that is the basis under which the side pocketing is done. We also believe that the side pocketing will be resorted to by the AMCs only when it is really necessary. It is not as if that there is a side pocketing that the AMCs or the fund managers are emboldened to take further risk, because it's a reputation risk when you use the side pocketing. So I'm quite sure that the AMCs will use the side pocketing in a very responsible manner, and that will ensure that it is for the benefit of the existing investors in the particular scheme where the side pocketing is done.
Anant, if this were to be done by a bank, we'd call it evergreening. In the case of mutual funds, we call it side pocketing. So is it just a question of semantics? And for all the talk of retail participation, the fact is that even today, retail investors account for a much smaller share of the AUM. Do you think this will change at all, particularly given what we're seeing in the debt market mutual funds? Anant?
Look, Mythili, side pocketing is not ideal, right? It is an aberration. Hopefully, it will be used very, very sparingly. But in a sense, side pocketing actually helps to protect the interests of that retail investor you just spoke about. What could happen if a certain bond was to suddenly turn illiquid and default was that, as you rightly mentioned, the savvy institutional investors could actually exit from the fund immediately, leaving that unsaleable illiquid bond in the hands of the less savvy retail investors. By allowing side pocketing, which is, yes, it's not ideal, by allowing side pocketing, you ensure that everybody's in the same boat and that the less savvy retail investor is not disadvantaged because of his or her position. But hopefully this will be used extremely sparingly and the need for it won't be there at all. Just a couple of quick other points. Mr. Gupta mentioned rightly that you should not do evergreening by way of allowing repos on illiquid paper. I completely agree with him. The point really is not so much for providing liquidity and repos against illiquid or defaulted paper. The point is for providing it against good paper. You have to remember that a vast majority of mutual fund holdings continue to be extremely well-rated paper. Yes, some well-rated paper also descend into default very quickly, but most of them are quasi-sovereign or good-rated paper, which will stand the test of time. So what you want is liquidity for them, so that at least redemption pressures can be handled in the short end. So it's not really a question of trying to evergreen and kick the can down the road on the illiquid paper, really. But yes, as far as regulations are concerned for mutual funds, I think unlike capital and liquidity, what we need is suitability and appropriateness standards. What could be happening is you could have mis-selling of mutual fund products because you have over 100,000 registered people who can sell mutual funds to B30 and many small cities. You really don't know what is being promised to the investor. So suitability, appropriateness, and awareness about what risk they're entering into, particularly given illiquidity, etc. I think that is the part that has to be focused on.
Oh yes, a great deal needs to be done as far as investor education is concerned. But Mr. Gupta, the fact is that not all the money lent by banks gets repaid. In the same way, we must accept that not all the money lent out by mutual funds will come back. But there the similarity ends. In the case of banks, it is the taxpayer who picks up the tab. But in the case of mutual funds, it is the investors who bear the loss. Have retail investors understood this fundamental difference, and are they willing to go along with it, Mr. Gupta?
See, as far as I feel that retail investors very rarely knew that in mutual fund you can have a situation of a bad debt, and now they are realizing that yes, mutual fund also, the debt mutual fund also could be having a bad debt. Now the situation is this. In banks, you sell the bad debt to ARCs. In mutual fund, you are creating a side pocketing. And I would disagree with Mr. Anand, where he said that repo is better than side pocketing. I think side pocketing is better for the simple reason it will expose that the mutual fund has done something wrong or mutual fund decision was wrong. When you go for the liquidity thing, the investors would not know what happened. So side pocketing is at least a little bit more transparent mechanism. And the second thing is in side pocketing, it's like this, you are isolating a diseased product. So similarly, when you isolate a person who is having a disease, so you are isolating an investment which is not of the same caliber or same class as other assets. So I think that is the right thing. But again, going forward, unless until the participation is wider in the debt mutual fund also, the risk will remain, because what happens if one big investor withdraws, then there is a redemption pressure on the fund, and that pressure works against interest of all the unit holders.
Absolutely, but come to my series of my last few questions, and this is addressed to all three of you, and this concerns the role of rating agencies. Even if rating agencies had messed up big time, and they do it again and again, can debt fund managers really absolve themselves of blame, or were they so blinded by the high yields that they disregarded the risks that they could have seen themselves? How can they be made more accountable? Venkatesh, rating agencies, how do we make them more accountable?
I would say that the rating agencies have been doing a reasonable job. Whatever you are seeing here is on the few instruments where the ratings have suddenly deteriorated beyond the control of the rating agency. I would put it like that. But having said that, maybe the rating agencies could do much more closer monitoring of the rated instruments so that they are able to come to the market and give their communications at a much more faster pace, so that the markets as well as the fund managers are able to react to that particular information in a better and orderly manner. The fund manager in turn is doing due diligence in addition to the rating agencies due diligence. So I'm quite sure over a period of time this will get sorted out. But if you look at the overall perspective, you actually see that out of the 15 lakh crore in the debt fund, around 10%, 1.5 lakh crore is in the credit fund, and out of that 1.5 lakh crore in the credit fund, hardly around some 20,000 crore is where this problem lies. So in a overall perspective, I would say it is very, very less. But even when it is less, we should actually use this opportunity to tighten our systems, process and controls, and ensure that the risk management is done in a much more better fashion, so that the risks are mitigated. So I would say that the rating agencies have a role to play. The rating agencies will have to communicate closely and ensure that the controls within themselves are also done in a much more better fashion.
Anant, I'm not so sure I agree with Venkatesh on rating agencies. To my mind, they seem to bear a charmed life. In fact, in the latest monetary policy statement, the Reserve Bank of India has told banks to use ratings to decide the risk weight for NBFCs. How do we ensure that they're made more accountable? Because if you've seen, I would think banks are in a far better state to assess the risk than rating agencies who have no skin in the game. Anant?
Very quickly, Mythili, look, rating agencies in India provide two services. One, of course, rating of the paper itself. Second, some of them also, remember, provide valuations of the paper for NAV purposes. On the first bit, I would rather put the onus on the AMCs or the banks themselves. The primary responsibility for doing the credit appraisal is of the mutual fund and the AMC. It's not of the credit rating agency. If there is anything I would require or request, I would request that AMCs spend a lot more resources on beefing up their own credit departments and ensure that the primary responsibility lies with them and that they don't rely on credit rating agencies except as a secondary check. On the valuation part, I have a bigger problem. It's not just to do with the rating agencies. They happen to provide the valuation. Look, if you have volumes which are monthly volumes, which are 1/3 of the total AUM of the debt mutual funds, you know the valuations are going to be questionable. Now, there are ways in which you can strengthen the valuation process, make it more market linked, make it more, how should I say, robust, to ensure that there is no conflict of interest, that the people providing the paper are not the ones providing the valuation obliquely. And if they are, there is transparency and around who's doing what and who's providing what valuations. I think that entire process has to be strengthened. SEBI has put out a consultation paper on changing the valuation processes, and I think that should go a long way into strengthening the whole process. One quick point I'll add on Mr. Gupta's comment. I'm not suggesting that repo is a replacement for side pocketing, not at all. Side pocketing is required to protect small investors for defaulted paper. Repo is required because I'm saying our secondary market volumes for good paper is low in comparison to the AUM held by mutual funds. Given that situation, if you have large redemptions coming through, there isn't a lender of last resort available currently. It's not a desirable situation. We can question why we are where we are, but that's reality. So if you want to stave off a crisis and an unnecessary panic, you might have to have a decent repo market available for good paper, not for defaulted paper, as a contingency plan. It's not desirable, it's academically not pure, but at the moment you might have no other option really. That was my limited point.
Mr. Gupta, would you agree, at least as far as Anant is concerned, says that the primary responsibility remains that of the debt fund manager, not of the rating agencies? And today that is where we are finding debt fund managers taking the easy way out and just depending entirely on rating agencies. Would you agree, Mr. Gupta?
I would agree, but I will add certain more things.
Please.
If you recall, the 2008 crisis was primarily the doing of the rating agencies, and the model that rating agency operate, that they get money out of the person whom they are rating rather than the user. I would suggest as way forward that every investor cannot get it rated, but MFI and Association of Insurance Companies, they can at least say that they will have the paper rated by themselves rather than the companies getting the paper rated. That is one. It may be sounding outlandish, but this is the idea which has to be worked on. Second, agree that the rating is a supplement, not supplanting the decision of the fund manager. And the third and more important is this, that everywhere in India, most of the time, the assessment is based only on the financial factors rather than the other very important factors which are the governance factor. Because I feel the good governance is a prerequisite for future success, and unless until rating agencies or mutual fund or banks, they bring in their assessment the governance factor as an important tool for determining the future, probably such type of mishaps would continue happening.
Oh yes, entirely. Of course, good governance is something that is very important, not just for rating agencies or mutual funds, but for all of corporate India. And Venkatesh, I think Mr. Gupta has given you some work, given AMFI some work. So hopefully we will see some improvement in down that line. But I'm afraid we've run out of time completely. So we'll have to end this discussion now with a number of takeaways as far as debt mutual funds are concerned. Hopefully we will see some improvement, and retail investors will understand that debt mutual funds are risky investments. They are not the same as bank deposits, and mutual fund managers will also try and ensure that there is transparency and all the disclosures that are necessary are made so that we don't have this kind of a situation again. Thank you so much, Venkatesh, Anand and Mr. Gupta, for joining me in this discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.